Mortgages are one of the most important financial tools most people will ever use, yet they are often misunderstood. In simple terms, a mortgage is a loan you take from a bank or lender to buy a home or other property, and you agree to pay it back over time, usually in monthly installments. What makes a mortgage unique is that the property you buy serves as collateral for the loan, meaning if you fail to make your payments, the lender can take the property through a process known as foreclosure. Understanding how mortgages work is crucial, because for many people, it's a commitment that can last decades and cost hundreds of thousands of dollars. Let's start by looking at what makes up a mortgage payment. It's not just the money you're repaying for the home itself. Most mortgage payments are made up of 4 components, often referred to as PITI: principal, interest, taxes, and insurance. The principal is the portion of your payment that goes toward reducing the amount you originally borrowed. Interest is the fee the lender charges for allowing you to borrow that money, expressed as a percentage of your loan amount. Taxes refer to property taxes, which are collected by your local government to fund things like schools, roads, and emergency services, and they're often built right into your mortgage payment. Insurance is also included, covering things like homeowners insurance to protect you against risks like fire or theft, and in some cases mortgage insurance, which protects the lender if you default on the loan. Now, let's talk about the different types of mortgages. The most common is the fixed-rate mortgage. With this option, your interest rate stays the same for the entire term of the loan, meaning your monthly payment stays predictable year after year. This is a great choice for people who want stability and plan to stay in their home long-term. Next is the adjustable rate mortgage, or ARM. This type starts with a lower interest rate for a fixed period, such as 5 or 7 years, and then the rate adjusts periodically based on market conditions. While ARMs can be cheaper at first, they carry the risk that your payment could rise significantly if interest rates go up in the future. Then there's the interest-only mortgage. With this option, you pay only the interest for the first several years, which makes your initial payments lower. But after the interest-only period ends, your payments increase because you start repaying the principal as well. Finally, we have government-backed loans. These include FHA loans, which allow for smaller down payments and more flexible credit requirements. VA loans for eligible military service members and veterans, which often require no down payment, and USDA loans for rural and certain suburban areas, also with little or no down payment. Understanding the process of getting a mortgage is just as important as knowing the types. It typically begins with pre-approval, where a lender looks at your income, debts, credit score, and financial history to determine how much you can afford to borrow. Next comes the home search and making an offer on a property. Once the seller accepts your offer, you move on to the loan application, where you submit detailed documents such as pay stubs, bank statements, and tax returns. After that, the lender goes through underwriting, a process where they verify all your information and assess the value of the property you're buying. If everything checks out, you move to closing, which is when you sign the final paperwork, pay any closing costs, and officially take ownership of the home. There are a few terms you'll hear often in the mortgage world. The down payment is the upfront amount you contribute toward the purchase of the property, typically ranging from 3 to 20% of the home's price. Amortization is the process of gradually paying off your mortgage through scheduled payments over time, with each payment reducing both the interest and the principal. Private mortgage insurance, or PMI, is required if your down payment is less than 20%. It protects the lender in case you stop making payments. And equity refers to the portion of the home you truly own, the value of the home minus the remaining balance on your mortgage. Like any major financial decision, taking on a mortgage comes with both pros and cons. On the plus side, mortgages allow you to buy a home without having to pay the full price up front, and as you make payments, you build equity, which can increase your wealth over time. In some countries, there may even be tax benefits to paying mortgage interest. On the downside, A mortgage is a long-term commitment, and over the life of the loan, the interest you pay can end up being a large sum, sometimes more than the original price of the home. And of course, if you fall behind on payments, you risk losing your home through foreclosure. So, how do you approach a mortgage wisely? First, work on improving your credit score before you apply. A higher score usually means a lower interest rate, which can save you thousands of dollars over the life of the loan. Second, don't borrow the maximum amount you're approved for. Just because a lender says you can afford a certain amount doesn't mean it's the right choice for your budget. Third, shop around and compare offers from different lenders. Interest rates and fees can vary significantly, and even a small difference in rate can make a big difference in your monthly payment. Lastly, remember that owning a home comes with costs beyond the mortgage. Maintenance, repairs, property taxes, and insurance should all be part of your financial plan. In summary, a mortgage is more than just a way to buy a house. It's a financial agreement that shapes your budget and lifestyle for years to come. By understanding the parts of a mortgage payment, the different types of loans, the application process, and the key terms, you put yourself in a stronger position to make smart choices. Mortgages can be a powerful tool for building wealth and stability, but they require careful planning, realistic budgeting, and a solid understanding of how they work. If you take the time to learn the details, shop around, and plan for the long term, your mortgage can be a stepping stone toward a secure and comfortable future.